As you sit to file your income tax return, don't forget these common exemptions and deductions to lower your tax outgo. Welcome to TOI Wallet Talks. From TDS to Section 80C to Section 80TTA and exempt incomes, in this episode, Parizad Sirwalla of KPMG in India explains some common tax exemptions and deductions that you should not miss out on when filing your income tax return. So Parizad, my first question to you is that, banks will cut TDS on FDs and companies will cut tax on dividends. So where should I be looking for these deductions when I'm filing my income tax return so that there is no excess tax paid?
Sure. So the tax deducted at source, whether it's the bank fixed deposit interest or the dividend that you receive from the companies, you will all get it in your Form 26AS. These days, everything, your entire financial life is available digitally. So 26AS, if you download, then you'll get all the details there. That is one avenue to look at. Separately, as a deductor, so the bank or the company paying the dividend and the interest, as the case may be, will also issue to you the Form 16A, which will give you the details of the income and the tax deducted at source. That is another document that you can look at. And additionally, you will also have your annual information statement, AIS, TIS as it's called. Please do download that also from the income tax portal, and collectively with 26AS, your Form 16A and your AIS, TIS, you will get the full picture of all the tax deduction at source on these elements of income. And then you can sit and reconcile and match the incomes and the TDS as well. All this can be downloaded if you log in to your income tax portal with your, individual passwords, PAN accounts. 26AS, you also have the facility to, download it from the Traces website. So easily available at the click of a button.
Okay. But, for example, there is Section TTA, in which income up to a certain level is exempt from tax, but above that you have to pay a tax. So are there any similar sections and provisions that I should be aware of?
Generally there are some deductions which are called Chapter 6A deductions for the purpose of the Income Tax Act. And, the popular ones, as you already mentioned, are 80TTA, which is the deduction available to individuals for interest on, savings bank account or post office accounts, which almost all of us would have. The limit is actually 10,000 per annum. That's one section. And then you have, if you happen to be a senior citizen, then it's 80TTB for the same interest. In addition, senior citizens also qualify for interest on fixed deposits if they have, or senior citizen savings scheme. So they get deductions for interest therein up to a higher limit of 50,000 per annum. But over and above these deductions, there could also be certain elements of income which are taxed separately or at different rates. If I were to just give you an example, if you have long-term capital gains on sale of your Indian listed equity shares, or if you have equity-oriented mutual funds, again, which is very common for individuals to invest in the capital market scheme, such long-term capital gains generally qualify for tax rate at 10% plus applicable cess and surcharge, as the case may be, on any amounts exceeding 1 lakh rupees. And that's under Section 112A of the Income Tax Act. Similarly, if you are a real estate, you own real estate and you have rental income, you've let out your property, and of course you're taxing the rental income, you get a flat deduction of up to 30%, for calculating income from house property on your rental income. That's coded in Section 24A of the Act. Things like that. Then if you're a salaried individual, while your employer generally takes care of most of the exemptions and deductions while calculating TDS on your salary, but you do have some items like standard deduction up to 50,000, which gets offsetted from your salary income. A few quick ones are also if you've contributed as an employer to the new pension scheme or NPS, then up to 10% therein gets, exempt. Then there are small ticket items if you've structured in your compensation, like meal vouchers or gifts below a particular threshold, so on and so forth. And then your retiral benefits, as the case may be, with the gratuity, leave encashment, up to certain specified thresholds are exempt from tax.
Under the old tax regime, which people opt for, the Section 80C is a very well-known thing where you can invest in a lot of things, and then you can get exemptions out of that or deductions out of that. So are there any other sections that I should be aware of where taxpayers can claim deductions or claim refunds so that they have an overall lower tax liability?
Yeah, so the most popular you've already disclosed, and we sort of, every time everyone talks about ATC, which is a pretty sort of bundled up limit of 1,50,000 per annum. Almost all your specified investments and expenses come therein. But over and above ATC, you do have ATCCD, to be precise. Within that subclause 1B, again, you get an extra deduction of 50,000 rupees if you contributed to the NPS scheme, which is the Tier 1 scheme. This is in addition to the NPS contribution that is already bundled under the ATC deduction. Then there are a host of deductions linked to the medical part of expenses. As an example, Section 80D of the Act is basically a deduction for your medical or your health insurance premiums that you pay to the tune of rupees 25,000 per annum. And that insurance premium you could have paid for self, spouse, dependent children. For each of the section, what qualifies as specified, and up to 25,000 you get as a deduction. Over and above that, if you have parents, so whether they are dependent on you or not, and you're paying health insurance premiums for them, then you get an additional 25,000 on those premiums as well. So on and so forth. Then there is a deduction of up to 5,000 rupees in respect of payment that you make for any preventive health checkups. Of course, it's part of this overall limit of Section 80D, but these are, towards medical insurance premiums paid. Then there is another section, the way we said 80D, there is an 80DD. It goes on for deduction for medical treatment. If you have if you are having a person who's a dependent on you, who unfortunately has a specified disability, and you're taking care of the dependent person, who's again defined, could be spouse, children, parents, and brothers, you get certain thresholds of again 75,000 rupees up to that. If you are in that situation, it again increases depending on the extent of the disability. If it's a severe disability, it's up to the tune of 1.25 lakhs per annum, so on and so forth. If you yourself, in the unforeseen event that you're going through certain very terminal or specified diseases that are again coded in the law, example, certain terminal ailments like cancer or other neurological diseases, and there are a host of ailments specified. Unfortunately, if you're in that situation yourself and you're spending, then the deduction available is up to 40,000 under 80DDB. Again, if you happen to be a senior citizen and you are in that situation, then the limit goes up to 1 lakh, so on and so forth. Some of us are also making donations towards certain charitable institutions. There is a Section 80G, which is a prescribed section for benefits given for donations. Again, it's subject to certain thresholds. Certain donations qualify for 100% deduction. Some are capped at 50%, subject to limits on gross total income, so on and so forth. If you are not having a component of house rent allowance in your compensation, or if you're a non-salaried person, but you still happen to stay in a rented property and you're paying rent, you can even claim under Section 80G of the 80GG of the Act a deduction of rent paid up to a prescribed limit. While the limit is not very high, the maximum deduction is 5,000 per month or 25% of the total income, whichever is lower. So that's towards rent. For people who spend money on higher education by taking a loan, there is Section 80E, where interest on loan taken for higher education for self, spouse, and children, very common in these days, is available to the individual for 8 years, so on and so forth. And again, there is Section 80U for other certain types of disabilities, where the deductions go up to 75,000 to 1,25,000. Moving away from Chapter 6A deductions, there's also Section 24. Again, if you're into real estate, which most individuals own homes, and if you have a self-occupied property which is on mortgage, then you can claim the interest deduction on the housing loan up to 2 lakh rupees. And if you have rented out that property which is on mortgage, then for rented property you can claim the full interest deductions, or so on. One has to be mindful of limits depending on the situation. There are limits for set off of loss from house property, so on and so forth.
Parizad, there are certain types of incomes that are exempt, but they need to be reported. So can you tell us the most common exempt incomes that people should know that they don't mistakenly pay tax on?
Yeah, so there's in your income tax return also, there'll be whole schedules for disclosing exempt income. Some of the common, not so common ones are agricultural income. Some of the common ones are if you happen to be a non-resident of India, then, and you have a, non-resident external account, NRE account, then interest on that is exempt under 10(4) of the Act. Amounts received on certain life insurance policies, subject to the premium to capital sum assured ratio, those get exempt. And, there have been a lot of changes therein in each year's budget. So, for instance, for ULIP policies, which are after Feb 21, if the aggregate premium was not exceeding 2.5 lakh rupees, then similar maturity proceeds were exempt. And if it was non-ULIP policy, the premium threshold was 5 lakhs. Then, of course, for your retirement benefits, anything that you withdraw from a public provident fund or a provident fund that you have, subject to, of course, specified conditions, or you may have had a superannuation fund on retirement, those amounts withdrawn in general, subject to specific conditions fulfilled, are generally exempt under the Section 10, which is the common section for exempt incomes. Then you have certain notified bonds, and interest that you receive on them is exempt under 10(15) of the Act. For those individuals who happen to be partners in partnership firms or LLPs, a share of profit generally is exempt from taxation. Again, the retirement part of, the gratuity benefits that you receive, there are thresholds of 20 lakhs lifetime. That's the amount of gratuity which is generally exempt. And similarly, leave encashment is these days enhanced to a 25 lakh limit from April 23. These are once in a lifetime, limit specified. And again, then, payments from the NPS scheme also on certain partial withdrawals are also exempt under Section 10. So that's most of the exemptions.
Parizad, what about people who are opting for the new income tax regime? Do they have any deductions or exemptions that they can make do with?
Almost all that we spoke about is by and large not applicable if you opt for the new regime. So one really has to do the maths behind your own situation. But what is available still under the new regime is interest on home loan only for rented property. That is still allowed under the new regime. Employer contribution to NPS is still allowed. And there are, other items like transport allowance, per diem, conveyance allowance, and the items of gratuity exemption and leave encashment that we just spoke about. Those continue under the new regime, but few and far, most of the other Chapter 6A and Section 80 deductions that we spoke about, those don't come within the ambit of the new regime, because that's the intent, that lower tax rates, but, not deductions.